Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 31st of March 2020. And yesterday we produced two videos. Financial News Daily Market Update for the 30th of March. And gold and silver prices fall. What about premiums? And we've placed links to both of these in the description box below. Now in our daily market update we quoted Louise Kernohan, the investment director for UK Equities at Aberdeen Standard Investments. And this is what Louise said, quote, "I think the markets want to have hope, but the reality is there is still more pain to come in the short term," unquote. In the past 40 or so years that one has been involved in one way or another in financial services, one has seen numerous stock market falls and crashes, property values boom and busting, emerging markets prospering and collapsing, and precious metal prices skyrocketing and descending with equal vigour. A common question often asked when markets do well is, are we at a peak now? And when markets fall, are we now at the bottom? These are the essential questions investors and potential investors want or need to know before they take that risk and plunge their savings into those markets. Now, a broad rule of thumb that many advisors, particularly those who'd been around for a while, took was that every 7 to 10 years we would have a boom and bust cycle. And with few exceptions, whatever was bought 10 years previously would be worth more 10 years later. Of course, it did not fit every situation, but as a general rule, it worked out. And especially if one was prudent or lucky enough to sell whatever they had within 2 years of the peak and buy back within 2 years of the bottom. You didn't necessarily have to hit the exact peak and the exact bottom in those days. As long as you were within 24 months, 10 years later, you do extremely well. Now, we would suggest that the situation has not changed a great deal in current times, save that perhaps the cycle has been elongated, and to some extent, and particularly with equities, computerization speeds up the process, providing you with faster and steeper peaks and troughs. However, that said, with governments and central banks essentially by default now adopting modern monetary theory economics, they have managed and may continue to manage to delay a long overdue recession. But what no one really knows the answer to is for how much longer they can continue to achieve this. So with recent stock market falls, investors, a number of whom, particularly professional investors, have managed to amass hoards of liquid cash, are asking, have equity markets now bottomed, having seen the recent rises of the past few trading days, and is it time to invest? So let's take a look at 3 articles on this subject published in the last few days. Bloomberg article dated 30th of March, 2:50 p.m. GMT. JP Morgan says the market rout is probably past its worst now. Quote, strategists at JP Morgan Chase & Co. have concluded that most risk assets, a universe that typically includes stocks and credit, have seen their low points for the recession that's gripped economies around the world. Conditions that JP Morgan had set for market stabilization and revival have largely been met, with recession-like pricing, a reversal in investor positioning, and extraordinary fiscal stimulus. Strategists led by John Normand wrote in a note on Friday. Risky markets should remain volatile, but enough has changed fundamentally and technically to justify adding risk selectively, Norman wrote. Most risky markets have probably made their lows for this recession, except perhaps oil and some emerging market currencies beset by debt sustainability issues. Most risk assets should trade higher in the second quarter of the year, Norman said. He recommends that investors average into oversold markets, particularly those where central banks are buying directly. Averaging into markets entails spreading out the purchases over time rather than diving in one go. But not everyone sees the bottom as necessarily in. Goldman Sachs Group Inc.'s David Kostin reiterated in a note on Friday that he expects the market to turn lower in coming weeks. He cited a checklist for a sustained rally similar to Norman's of slowing viral spread, evidence that fiscal and monetary policy stimulus is working, and a bottoming in investor positioning and flows. Gavikal Research Limited's Anatole Kaletsky said in a note Monday that it's too early to buy equities, citing reasons including surprisingly complacent investor sentiment and historical data showing bear markets almost never end on a single massive sell-off without retesting the bottom. The MSCI All Country World Index tumbled some 34% from its February record high to its recent low on March the 23rd. As of early New York trading Monday, it had recouped more than a quarter of that loss. Norman said his approach dovetails with the recommendations in the past week from bottom-up analysts at JP Morgan to add exposure in United States and European credit, peripheral European sovereigns, and US and European inflation break-evens. On the stock side, things are somewhat more nuanced. JP Morgan's multi-asset portfolio has been overweight equities all year, though partially hedged with short positions in credit and long ones in the US dollar. Thus, future adjustments would be in terms of magnitude and funding source rather than in overall tilt, Norman said. He added that the firm's global equity strategists believe that the risk-reward for equities remains skewed to the downside because relief rallies will be faded. Norman cautions that not all apparently cheap markets should be bought, as there is still a risk-reward spectrum. Developed market bonds should be used to fund allocations to cheap credit and equities, but bond sell-offs should also be used as opportunities to buy duration as insurance against the next shock. Credit generally has higher risk-adjusted returns than equities, so in volatility-adjusted terms may be superior in the market bottoming process over the coming weeks, Norman said. End of article. Reuters article dated 31st of March, 8:35 a.m. GMT. FTSE 100 inches higher, yet closes in on worst quarter since 1987. UK shares rose on Tuesday as a recovery in oil prices and a surprise expansion in Chinese factory activity revived confidence in equity markets, amid a deep sell-off this month that set the FTSE 100 on course for its worst quarter since 1987. The FTSE index rose 2.1%, with turnaround specialist Melrose Industries surging 19% after it secured a debt covenant waiver and said it was cutting expenses. Cigarette maker Imperial Brands rose 11%, as it secured a new €3.5 billion credit line. The latest data from China showed factory activity unexpectedly expanded in March from a collapse the month before, but analysts caution that a durable near-term recovery is far from assured. Quote, "What we're really looking at, the China data, is to see if it's an indicator of how quickly Europe and US can get back to work potentially after their lockdown, unquote, said UBS strategist Kiran Ganesh. If it ends in May, which is what we're broadly pricing in, then we may see a similar path of what we've seen in China, unquote. The FTSE 100 has recovered about 15% since hitting a near 9-year low on March 16, but remains nearly 25% below its January record high. Oil prices steadied following a near collapse on Monday as US President Donald Trump and Russian President Vladimir Putin agreed to discuss stabilizing energy markets, boosting shares in Royal Dutch Shell plc and BP plc. Travel stocks have also been hit hard in the past month in the face of an evaporation in passengers, with the wider travel and leisure index. Supermarket chains Tesco and Sainsbury's have held up, as industry data showed British consumers spent an additional £1.9 billion or $2.4 billion on groceries in the 4 weeks to March 21st. End of article. Yahoo Finance article dated 29th of March by Julia LaRoche. Why the Dow's best week in 82 years is no reason to get bullish. After stocks were pretty much in freefall the first 3 weeks of March, the Dow staged its best week in more than 80 years as Congress passed its historic relief package. This past week, the Dow Jones Industrial Average ended up 12.8%, its best weekly gain since 1938, while the S&P 500 climbed 10.3% for its best week since 2009. However, Wall Street experts are cautioning that this might not be a sustained rally, and warning investors to prepare for what could be a bumpy road ahead. In a March 27th note to clients, Goldman Sachs US chief equity strategist David Kostin wrote that, quote, bear markets are often punctuated by sharp bounces before resuming their downward trajectory, unquote. Looking back, Kostin pointed to 6 distinct bounces of 9% or more between September 2008 and December 2008. Quote, most bounces involved optimism around monetary or fiscal policy support. However, the market low did not occur until March 2009, when the pace of economic contraction began to slow, unquote, Kostin added. RBC Capital Markets head of US equity strategy, Lori Calvasina, also highlighted this to her clients on March the 26th, describing big down days as well as big up days as a hallmark of that period, just as they've been today. Quote, this analysis continues to keep us concerned that the US equity market hasn't found a bottom yet. It also reminds us that after the most severe equity market drawdowns, durable bottoms have taken time to form, something we think will be the case this time round as well. We are growing increasingly skeptical about the V-shaped recovery thesis in stocks. In particular, we're concerned that there's been too little discussion about the longer-term collateral damage, Calvasina wrote. It's also along the lines of what Jefferies chief market strategist David Zervos pointed out in a client note sent on the 22nd of March at what happened in the months following the passage of TARP. Quote, even after a fiscal bailout was agreed in early October 2008, it wasn't until about 6 months later that the risk asset markets finally bottomed. And to be sure, those 6 months felt like an eternity. I would thus not yet get too excited, too quickly, about a sharp sentiment reverse, even if more positive news begins to flow on a fiscal package. Maybe this time will be different, but right now I have my doubts, unquote, Zervos wrote. In an op-ed on Sunday, Mohamed El-Erian wrote that the optimists see a bottoming starting to form, while the pessimists see a dead cat bounce, similar to what happened between September 2008 and March 2009. L. Arian's outlook at the moment is, quote, for high stock market volatility around a still downward trend, unquote. He also added, as such, it is more of an up in quality repositioning opportunity within a strict overall risk mitigation approach than an all-clear signal for investors. End of article. These three articles at least highlight to us the fact that professional investors would love to believe that equity markets have now bottomed and that it's time to get back in. After all, even today, while we produce this podcast at just prior to midday GMT, we can see that most US bourses closed up over 3% yesterday, and UK and European markets are up over 1% this morning. But we also did not get the feeling from these articles that the authors were particularly persuaded, and if anything, we should perhaps expect to see more dips, testing previous lows, before such a bottoming determination can be made. We frankly would agree with this, though having said that, we would be surprised if the equity downside was more than another 25%, and the upside more than 40% from current levels. So the risk-reward ratio in uncertain times is perhaps not quite so attractive, though positive. Should we see equities fall another 15% from current levels, then our view may very well change. For even if that may not quite be the bottom, for us, based on our previous strategies, it could be close enough. Now, as we said earlier, no one really knows. But what has been clear so far is that our barometer, gold, has held up well in the recent past. But if we actually look at those rises, they're quite telling. In that, over the past 12 months, in US dollar terms, gold has risen 24%. But then, over the last 6 months, it's only been up 8%. In the last 3 months, up only 5%. In the past month, up only 1%. In the past week, up only 0.7%. And today, it's down 1.5%. So, if investors truly believe that equities had much further to fall, we're of the opinion that gold will be rising much faster than it is, or much faster than it has done. Now, that does not mean, of course, the situation cannot turn around. But for the moment, it does appear that investors are dipping their toe back into equity markets, or are still holding onto their cash reserves for when they believe the time is right. We've expressed our view. We would certainly welcome you expressing yours. Meanwhile, thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. And we've also, late last night, published a video on the Richard and Greg channel, which we equally hope you have subscribed to as well. And this evening, we will be providing another daily market update. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.